Welcome to today's webinar, Financing Growth Institutional Investment in the Debt Settlement Industry. My name is Felix Shipkevich. I'm the principal of Shipkevich PLLC. My firm has offices in New York, Miami, and London. I will be the moderator of today's session. And personally, as an attorney, I've been in this space now for 10 years. Totally practicing law in my 23rd years, but I'm celebrating my 10th year anniversary since 2015, since I've been heavily involved on the regulatory side of this space. So what's the purpose of the webinar today and why it's important? Well, the debt settlement industry right now is in a period of significant growth. I've heard numbers, and I can't substantiate this number, but something to the effect that since 2018, 2019, the industry has grown fourfold. I'll let James and Rob see if I'm correct or incorrect later, but this is what I heard. And it's continuing to grow. Now, of course, with any industry that's growing, new market participants are coming into the space and funding those market participants. And when I say market participants, I generally will refer to debt settlement companies, attorneys who practice in this area, and also front ends, right, or marketing companies that introduce business to attorneys and debt settlement companies. So funding is critical. And in the past, I would say 3 years, immediately after the pandemic, I've seen an infusion of private equity family offices and hedge funds and some private individual and high net worth individuals who have been sort of poking at the space and exploring their opportunities. Now, in comparison to other industries, the debt settlement space institutional side is what I would personally call in its early stages or infancy stages. I do work on the fintech side with banks, money transmitters, and crypto exchanges, and those obviously areas have been, heavily funded by institutional money from private equity firms, funds, family offices, and high net worth individuals. But certainly, there's right now tremendous room for expansion. Why now, right? Why now? I can tell you that I was very honored to attend ACDR's event 2 weeks ago. James, we had a few chats there, and I see a lot of new faces, a lot of new participants. There's tremendous interest in the space, and that clearly creates an increased appetite for institutional participants to look into the space and potentially structure deals. Now, before I introduce, I'm going to turn it over, to James and Rob to introduce themselves and what they do and a little bit about their companies. I quickly want to talk about the topics we intend to cover. Now, in preparation for this, we wanted to keep this to 30 to 35-minute discussion with the panelists. And then if you have questions, instead of raising your hand, you can put them in your chat, and we will. I will, after the last topic is discussed, I'll turn it. I'll read those questions. So let me turn it over to Rob. Rob, if you could kindly tell everyone a little bit about yourself and what you do.
Cool. Yeah, pleasure to be here, Felix. Good to chat as always, James. And I'm grateful for the opportunity to talk to everyone who's dialed in here. Coromandel Capital, we are a private credit fund that provides senior secured asset-based lending solutions to fintech and specialty finance companies. Been around for about 7 years. Take institutional capital and deploy it to asset classes like debt relief and unsecured consumer, small business, all sorts of industries. Where we have an office in LA, and I am on the East Coast. Let me leave it at that for now.
Thank you, Rob. James?
Sure. James Shanahan, I'm the founder of NexGen Financial. We deploy capital in the debt settlement space, and it's a little bit different from how like a typical credit facility works. It's more of like a receivable purchase agreement where we're actually buying assets and then taking a participation in those assets. And it's a shared participation with the back end companies that we work with. We've been making these types of investments in the debt settlement space for a little over 8 years now, and we're working with about 15 different partner companies in the debt settlement space. And typically what we look for is somebody who has like a unique opportunity to really grow and enhance their business. And we look for ways to work with those companies that give them the capital that they really need to be able to grow out their infrastructure, be able to acquire more assets, and be able to really grow their book of business overall. So it's truly a partnership type agreement and situation and arrangement that we have in place with the companies that we work with. And we're able to provide them with unique insight and feedback on where they can really improve their businesses, optimize their businesses as far as like the rate of collections for the fees that they're going to realize, and also for the cancellations that they end up having because of our unique insight into how the different assets perform within the space. And we use our data analytics to really be able to give a lot of feedback to those partner companies that we work with so that we can help them look for opportunities to improve overall. And we definitely are seeing quite a bit of growth in the space right now, and really excited and optimistic about the opportunity to continue to invest and grow our investment in the settlement industry.
Thank you. And this actually is a perfect segue into the first topic that I'd love to get your feedback on. Um, tell everyone here, what is the current market appetite for investments into debt settlement? And when I discuss investments, it could be anything from capital infusion to factoring deals to M&A. And what are some of the recent trends? If you agree that there's what James, if I understand, you mentioned there's increased appetite. What are the recent trends that you're seeing in this industry?
Yeah, I think the appetite for deploying like debt and credit facilities in this space is extremely robust. There's a tremendous appetite for private credit funds to continue to deploy capital here. There is definitely an appetite for more of like the fintech or financially savvy banks to deploy capital in this space, more of like your specialty finance type investors. There's definitely a very strong appetite for continuing to increase facilities and for new entrants into the debt settlement space. And I think a lot of that, Felix, is because of the maturation of the industry overall. There's just a lot more history, a lot more data, a lot more visibility into how these assets really perform over time. And when we're talking about these assets, typically what we're talking about is just the fee arrangements that people are looking at factoring arrangements on or providing credit facilities for. So the visibility into what the fees are going to be from those assets, when they're going to come in, how quickly they're going to be realized. There's just a lot more history now around the industry on how those fees really perform. And because of that, because there's more history and because there has been growth in the industry, there is the ability to deploy the quantum of capital that a lot of these institutional investors would want to deploy. So those things have combined now to really provide a much more robust investment appetite for institutional investors to come into this industry, understand it, and then be able to make investments in this space because they can now deploy the quantum of capital that they'd want to. And you can easily see credit facilities being deployed from anywhere from 25 to 50 million, all the way up to several $100 million for many of the facilities that are now being offered in this space. And I think that's something that's relatively unique to this industry over the past couple of years.
And I can add on that too, just to give you guys some couple 2 cents on sort of the state of the union and debt relief. So, from our perspective, you having come from a highly regulated entity, you're working within banking and evaluating banks and finance companies, you see the pipeline of future clients and debt relief ever expanding, right? People go delinquent, they go non-accrual, they get charged off. You've seen that continue to increase across, secured from, all the way through unsecured sort of indebtedness. So we see the pipeline, from that perspective for folks on this call to be incredibly strong. We almost view this as a way, one of my partners kind of coined this as a way to kind of go short the consumer, right? So like instead of going long and just because consumers comprise such a large addressable market, right? Going long would constitute doing unsecured consumer loans, things of that nature. Being in debt relief, you're taking advantage of the fact, not taking advantage sounds really bad, but capitalizing on the fact that you have a pipeline of folks that aren't doing that well, and they're fortunate enough to find themselves working with debt relief businesses that are able to help them navigate these very precarious points in their lives when they don't qualify for bankruptcy and things of that nature. So, the consumers kind of muddled along. In our opinion, we've waited for them to, be less perseverant, and they've been incredibly perseverant, which is awesome because you want to root for the consumer. But the reality is personal savings rates remain pretty low. You've seen wage inflation not keep up with remotely cost inflation over a number of years, and as a result of that, the consumer is sort of somewhat weak. So I think that this provides a lot of really good tailwinds for DR in general, right? Is at least our position.
Something I want to piggyback of James mentioned, if you don't mind. You mentioned two things. One, you said the industry has been maturing, and the other one is that you see an increase in credit facilities. And correct me if I'm wrong, you mentioned 25 million to 50 million. That's sort of your kind of the typical range. Um, so let's start with the first one. Since when did you start seeing the industry maturing, and what do you think is the cause of that? And then if you could then comment on why that range 25 to 50 million. I understand that obviously it could be lower or higher, but why did you mention that?
Well, I mentioned that. I'll take the second part. The 25 to 50, I think, was kind of like, I think, industry standards a while ago. Now, I think what you're seeing is credit facilities that are being offered that are significantly larger than that, as there's more visibility into some of the dynamics that Rob mentioned. Like, there's definitely, I think, a macro trend in favor of the industry right now. And also there's been, very steady, consistent originations within the industry and growing originations within the industry. So because of that, there's much larger quantums of capital that can be deployed. So I think it's much more common now to be able to see credit facilities that are being offered that are significantly larger than that. I think that was kind of like the starter size several years ago. But I think to your point earlier, Felix, when you mentioned that there's been a significant amount of growth in the industry since like 2018 or the 2019 timeframe, I think we've been seeing that. And I think because of that, the credit facilities are getting much larger, and bigger institutional investors who want to deploy at least 100 million to 200 million to 300 million or more now have the ability to have visibility into working with several companies within the space that can do that. And so that's why one of the reasons why I think that there's been, a acceleration of the amount of capital that has been available in the space. And I think it comes down to like basically like the asset performance and the maturity of the infrastructure in place for a lot of the established companies. Companies, like 5, 6, 7 years ago didn't have the sort of operating history that they do now. So a lot of institutional investors wanted to see like cycle performance, like asset cycles, like how these would perform over like a 4 or 5 year time period. Now that many more companies have that sort of visibility and that track record of performance, it's much easier to be able to attract that sort of level of institutional capital that wants to see these assets and how they perform through a full cycle. So that's what I was alluding to with the maturation too of the industry, is that you really have a lot of like more sophisticated and bigger companies that have now been working and developing these assets and have been able to accumulate these assets and then overall evaluate and show the performance of these assets over a full cycle, which is exactly what institutional investors want to see.
And just to piggyback on what James was saying there, I think that, folks such as himself and folks such as ourselves, you know, helping folks understand how institutions look at their businesses and, you know, being the training wheels that allow them to take that first institutional capital and subsequently, use that to segue into doing direct deals with banks or even much larger credit funds or, and ultimately as some folks are, exploring securitizations. I think that the industry has evolved to, in a really, really, really strong and exciting way and I think risen to the occasion that, to sort of hit these milestones. And I think as a result, you've seen these larger funds, at least as we see it, right? Like we focus on that $0 to $30 million slug of capital of the senior secured debt. We've seen other folks come in and take out some of our counterparties or, also provide an additional financing next to ours. So I think you're seeing a lot more of that these days than we did, probably 5 years ago. I'm not sure, James, on your end, it seems a little bit more crowded these days, which I think is good, right? That'll, creates more competition amongst lenders and financing partners and drives down the cost of capital for the ultimate sort of operators, which is a good outcome.
Yeah, I think a lot of like big institutional investors have been tracking the industry for a while, and they didn't have the opportunities or the knowledge base to really be able to invest in this industry probably 4 or 5 years ago. But what we've seen is as we've been in the market for the last 4 or 5 years, we no longer get the questions about what is debt settlement. It's now more so how can we participate in the space? What is your model? What is your structure? How can we really look to work with you to deploy capital? And how does that capital get deployed and how does that evolve over time? And then, how can they structure around it so that they can participate in different positions within it, whether it's a mezz facility or it's a senior secured line, or whether it's even like taking a piece of the equity. So I think that there's just a lot more awareness overall because there has been a lot more history. There has been just a lot more performance history on how these assets really do perform. And that's one of the reasons why I think a few companies are talking to some of the banks out there to go down the path to do a securitization. Is because we now have the operating history for the way that these fees are collected, what percentage of them will be collected, and the consistency of that performance over time, which leads to being able to have the data to be able to do a securitization and be able to offer that as a financing solution. So I think it's likely that that will happen at some point in time, either this year, late this year, or early next year. We're one of the companies that has these fee arrangements and has a big book of fees that they've originated will actually go down the path and get those fees securitized, which would be the first time that that's ever happened within the industry. So it's a new issuance. It's a new asset class that will be securitized for the first time. And I think, like I said, it's likely to happen over the course of this year or early next year, which is exciting for the industry because it just provides more capital for the industry. It allows us to have more access to capital to continue to expand and to help companies grow, and hopefully does reduce that cost of capital as well.
So are you saying that securitization potentially is the new frontier, sort of the next step, institutional growth outside of your traditional funding?
Yeah, I think it's going to be an iteration of capital, having access to capital. It's just like there's no silver bullet for every company. There's nothing that is like the ultimate, like be all end all to provide all of the answers for capital needs. It's going to be part of the solution though. You'll have typical credit facilities, which are extremely important, asset-backed securities or facilities, which are really great vehicles to be able to use to grow a book of business. There will be equity dollars that will flow in. But for those companies that do have a really good sized book of business and have a good operating history and have great processes in place to be able to illustrate to the capital markets that they're going to have a sustainability with the performance of those assets, for those types of really large, well-established companies, they probably will be able to access the capital markets through doing a securitization. And that should help them reduce their cost of capital overall and may provide them with opportunities to grow at an accelerated rate because they could have access to cheaper capital than some of the other companies out there. But it's not the be all end all. It will be part of the solution. There is no one fundamental solution that will be the answer for everybody to continue to grow. And that's why there will always be opportunities for typical credit facilities, private equity, as well as securitizations throughout the over the future of this.
That's a good point because we people want to reduce cost of funds as much as possible. But what I would encourage people to do is create as much surface area with liquidity as possible because things like securitizations or the asset-backed security ABS market seize up from time to time, spreads blow out. You want to make sure you have credit facilities in place. Generally, those credit facilities are going to be lower levered and wider priced than the ABS market, right? But you also want to have things like these forward flows where someone might, like the James, provide a receivable purchase agreement, again, as an alternative form of liquidity, but also as a mechanism to, you know, with forward flows as compared to a senior secured credit facility, you might, get better economics in terms of like the proceeds that are, provided to you, which instead of raising more equity from, private equity or friends, families, and fools, wherever the money's coming from, right? You are better off in some cases, selling collateral, clipping more money up front, which you can then deploy into your business or using as equity to support a credit facility. So it becomes a scalable way of, creating equity without giving up ownership in your business. So what I would definitely, encourage everyone to do is as you're contemplating, your capital structure, have conversations with folks such as ourselves or James or whomever about the way to optimize that. And I would prioritize liquidity as opposed to cost of funds, just because you never know when something idiosyncratic happens with a financing partner, or the macro landscape changes more generally, or investors sour on it, or a regulator wakes up one morning, and decides they don't like the space, right? So surface level liquidity is one of the things I hope people walk away from this call with.
So we discussed a number of capital structures.
Yep.
If you are first time institutional, if you're seeking for the first time institutional investment, right? Let's assume that you're not a startup, but you've been in the space for a couple of years and you build you know, some client base, and you're either front end or back end, right? I'm obviously speaking hypotheticals. What capital structure would make sense for you uh, as a first time um, someone looking for it for the first time? What do you recommend, and what's currently available?
I'm happy to take that, or we can alternate however you want to do this, James. So what I would say is, in your formative years, you want to pay a premium for qualitative sort of relationship-based stuff, as opposed to trying to optimize for the lowest interest expenses possible, right? You want someone that is, the reality is, like, where we play in this market, and I think James similarly, right, is you want to find a patient partner that is going to withstand hiccups. There might be issues in terms of reporting that might happen. There may be, a state, regulator may come take a look at things, and you don't want sort of a weak hand to get, to basically call an event of default or find some mechanism to withhold funding to you. You want a partner who's going to be there in the business and help you go through these hiccups when things go boom in the night. I would say you don't need to have all your ducks in a row, right? I would say just be genuinely honest about the reality of your business, where the shortcomings are, and enlist feedback on ways to improve that. What I would most definitely say, which is kind of table stakes for folks such ourselves, is make sure regulatorily, working with someone like Felix and other folks like that, you are buttoned up. Just because, like, from a banking perspective, from a lending perspective, from a financing perspective, people want to ensure that their collateral is not deemed unenforceable. It's all great if you make a bunch of interest throughout the credit facility or financing, but it all evaporates, or it just pales in comparison to the principal that might get lost if the underlying contracts are deemed unenforceable. So I'd say first and foremost, take regulatory incredibly seriously, and that'll resonate with folks such as ourselves if you do that. The rest you can kind of figure it out, and you'll find patient partners to help you navigate that. Anything that you want to add there, James?
Yeah, I mean, I think to your point, it's essential to have everything buttoned up as much as possible on the regulatory front. Definitely work with Felix and other attorneys in the space that specialize in the space, that have experience. That's one of the essential things. That's one of the first things that we look at too, is basically who the companies work with as counsel for the various different partner companies that we work with. And we also do a regulatory review for each of the companies that we're going to work with. So we're going to get an opinion from like a Hudson Cook, who's going to look at their book of business, look to make sure that they're licensed and in the states that they're working in, and that everything is buttoned up on the regulatory front. It's a non-starter to not have that fully buttoned up at this stage of where the industry is. That's one of the key essential things. It's like basically, the starting place for where you need to be. Everything else can be, learned and improved over time, but that is the one non-negotiable. And I would say that, to Rob's point too, you want to look for somebody that does have some sort of flexibility in the way that they're going to look at the industry and structure the capital around the industry. You want to work with somebody who has experience here, because there definitely are nuances to the industry. There's attorney models, there's green state models. There's nuances that if you don't work in the industry and if you're not familiar with the various models in the industry, there could be surprises that could come up that could basically nullify or cause some of your financing to be put on pause for a while, until you work through some of those different nuances, until you can educate somebody on that. So you want to work with somebody who has experience and who understands it. And the way that we typically, like, the starting place for us is we definitely work with a lot of like newer companies, startup companies. And the way that we structure our capital is so that it does help you have like almost a bridge of capital that's almost quasi equity, quasi debt capital, to allow you to be able to grow the business and achieve like quantum of capital that can allow you to have access to capital to really grow your book and be able to acquire those new originations, those new growth opportunities that you have access to, while at the same time not requiring you to dilute your equity stake within your business. So that's one of the main things that we looked at and how we wanted to structure the capital that we provided, was to be like that bridge capital that would allow growing companies to really be able to expand their overall book and the overall amount of originations that they could do, while not needing to dilute themselves with trying to go out and find a lot of like private equity or friends and family capital, equity capital for their businesses. Because that is still one of the areas within this industry that's not nearly as well developed as the credit facility side. I think typical lenders really understand like the collateral, the pool of collateral that's available to lend against, and how to structure that collateral so that they can feel comfortable with their secure position within that pool of collateral. It's a little bit less, I think, mature and structured on the equity side. There's a lot less equity transactions that have happened within the industry. We've been able to go through a couple of private equity transactions over the last couple of years, and I'll tell you, they're not easy transactions to go through because it requires a lot of education. The first equity transaction we went through, it took a year basically from the start of the conversations to the close of that equity transaction, so that they could become familiar with the industry and understand it, and understand like the growth opportunities within the industry and the safety mechanisms within the industry on how to deploy capital. And so those types of transactions are much fewer and further between, and the quantum of capital there is significantly less than what you can get on the credit side. So it just is a little bit more like less seasoned and less mature of an area. And so that's why it's important to go with what Rob was saying and have that flexible capital that can help you through those like early stages of your business, so that you can have access to reliable capital as you're trying to really scale and grow your business.
Great. How talking about credit facilities, I just want to piggyback on that, and I appreciate you both talking about the regulatory side. And it was not a paid plug for my firm. I thank you. I appreciate it. Tell us a little bit, how long does the process take if someone's coming to you, James, for the first time and say, look, I want to set up a new credit facility. I've been in this business for, I don't know, 5 years, and this is my volume. Run us through, if you're comfortable giving us the whole kind of like, when do you start and when would you say, yes, I'm comfortable with onboarding you? And Rob, also feel free to, I don't know if you do the same. Yeah.
Yeah. So the first thing that we'll do is we'll get their data for what they've done historically, and then we'll just analyze their results, because each of the deals that we provide for people is based on their past performance. So each deal with us is unique. And so that's first and foremost. So we'll look at their data. I would say in the past, Felix, it would have taken us probably like 2 to 4 weeks to onboard somebody. But now with the level of scrutiny that we have and the institutional capital that we have backing us, and the amount of like the number of different people within each of the credit facilities that we have backing us, it now takes closer to like at least probably 6 to 8 weeks minimum to onboard somebody in order to go through the diligence, because now beforehand, we didn't necessarily go through a regulatory review of each of the different partner companies that we're going to work with. Now we have to go through that process. And it's because of the level of institutional awareness around the industry. Every time you bring in a new institutional investor, they have certain requirements about what they would want to see, what they want you to have for visibility into the regulatory front, but then also into like operational compliance that each of these companies is going to have. The performance of the assets, they want to understand like how each of them does perform relative to the other historical performance that we have. And we have covenants around each of those, each partner company that we work with, and around the portfolio in total. And so now it does take a little bit longer, but because we know the industry extraordinarily well, and we know most of the key players, and we know the types of businesses that they have, it's a more accelerated timeline than working with somebody that's new to the industry. Anybody that's new to the industry that's going to make an investment for the first time, we've worked with companies that we've brought into this industry, institutional investors that we've been able to acquire traditional credit facilities with, and it's taken them, sometimes up to 6 months in order to provide us with a credit facility, just because of needing to be able to get educated on the nuances of this industry, because it is relatively unique. Now that timeline could condense a bit now because there's more awareness and there's a longer history, but that's the last large credit facility that we raised. It took us over 6 months to be able to bring that on board.
So for us, every deal takes roughly exactly 47 days to close. I'm just kidding. So honestly, it depends. As James was kind of mentioning, in terms of like touch on data and things like that, if someone's incredibly buttoned up, has a data dictionary, the data is super clean, doesn't require like a lot of sanitation or homogenization, then we can turn analytics pretty quickly. So if we have that, I would say at that point, once we have that information, takes us generally 2 weeks. I would say soup to nuts, like from clean data submission to getting it through our investment committee to subsequently provide someone with terms. We front load that because in the financial analysis and that formative diligence period, just because that's where the rubber meets the road. The rest of it is kind of box ticking. I would say soup to nuts. It usually takes us 3 months from like a first conversation to a closing and funding. Right. Unfortunately, lawyers need a lawyer. No offense, Felix.
I'm taken. I don't like to.
Um, that generally the legal process takes, about a month on our end. Usually takes a week to, negotiate a term sheet, a week to do an on-site reference checks, background checks, all that sort of fun stuff. And then there's lags built in between. So I would say most people should budget 3 months. But what I would say is early and often, right? Even if you're not looking for capital, go have conversations with people who could perhaps extend it to you. Because the closer you are with someone, the more wisdom that someone's able to impart on you on what they or others might be seeking when that time comes, the better off you will be when that time comes.
Yeah.
So
Which is I'll give a quick plug to our firm's sixth annual regulatory workshop, which is always on the West Coast in Orange County. And I know James, you attend every year, or at least I always see you in the lobby, and your team shows up. I appreciate it, Rob. We hope to see you this year. It's going to be January 26th and 27th. We just announced a save the date, and so there will be, if you are looking for capital and you like to network with people who potentially have this capital. This workshop, in addition to obviously content, which is what people typically attend for, it's a good networking event to meet people in the space, and we will continue to talk about the institutional investment at that conference. Just again, a reminder: if you have any questions, please put them in the chat. But now is the perfect time to go to our final topic, which is where do you see this is all going in terms of institutional growth? Is it going to continue on the same path? Is it, I know something both of you touched upon was securitization as kind of the next, maybe perhaps frontier. But if you, glad to get your thoughts. So what is your forecast? Is it going to continue to grow?
Yeah, I guess I can take that one first. Yeah, Felix, I think, there's so much institutional awareness now around the industry. Yes, it definitely is going to continue to grow. There will continue to be additional people that want to invest capital in this space. There's so many large asset managers now. You can think about like the Apollos, the KKRs, the Carlyles of the world that we're having conversations with now that have vast pools of capital that they need to deploy. And those vast pools of capital that they have spread across every different unique way to deploy capital. It stems from doing a securitization to a traditional asset-backed line to mezz facilities down to equity. So all up and down the capital stack, they have pools and pockets of capital that they need to deploy. And they have a tremendous amount of new insurance capital that's going into all of those large asset managers. And those insurance investors need to invest in rated assets. So that's one of the reasons why there's been so much emphasis on trying to do new issuances and doing esoteric type asset classes and getting those esoteric asset classes rated is because there's so much demand for these large asset managers to deploy capital into rated securities. And that's one of the reasons why these assets will absolutely get rated. It's because these insurance companies want to deploy assets in this space, and they understand that this can be a very good place for them to invest, and it's a new pool of capital, and there's large originations in the space. There is definitely the opportunity for them to invest hundreds of millions of dollars annually in this space, which is one of the bare minimum amounts of capital that they would want to be able to have visibility into being able to deploy on an annual basis in order for something to be interesting for them. And so that's why I think we'll definitely go down that path. And I think ultimately overall, there definitely will be consolidation that happens in the space. The big companies just have, I think, an advantage in scale, and then also to be able to do the compliance and have the regulatory situation and processes be more buttoned up. And I think that that just overall is going to help allow them to have access to better, cheaper forms of capital longer term. So there ultimately will be more consolidation, I think, that happens within the space. And I think logical area of consolidation is for, some of these back ends to maybe consolidate and acquire some of the front ends that are in the space. And then ultimately there will probably be some sort of consolidation amongst some of the back ends as well, just because size and scale does matter, gives you cheaper capital, but then also there's like size and scale advantages from an operational standpoint and being able to operate and manage the companies efficiently. And that's kind of the overall forecast that I would have. I know it's kind of like broad, overreaching, but I think that there definitely is great opportunities for companies to continue to invest capital in this space, and it's going to be all up and down the cap stack.
I would echo that sentiment. So as an operator dialing into this call, I would take things like regulatory incredibly seriously. I would find ways to, start focusing on producing clean data. So folks such as James, such as ourselves, such as, larger players out there are able to, sort of be impressed when they come take a look under the hood and, realize that you are, are exuding a lot of sophistication, right? It doesn't need to be perfect, but just be honest and just, try and, do the best you can, as cliche as that kind of sounds, right? But like the reality is there's going to be a lot of capital available, and those people that exude these sorts of traits and manage their businesses well are going to be the beneficiaries of doing that, in my opinion. I think that, exactly as James mentioned, and we've mentioned a couple times on this call with securitization, other stuff, you are going to, get a lot more eyeballs reading what they call pre-sales reports or new issue reports. You're going to have rating agency methodologies that are going to be built around, this asset class in particular, which is only going to create more of a compounding effect on the visibility and growth. And I would encourage industry associations and lawyers and service providers to help support, the ecosystem more generally and making sure that people are acting compliantly. Just because, in certain industries, you have one bad actor, like, right now in auto, you have a company called Tricolor, who, it's going BK, and now everyone's like, oh God, like, is that going to happen to us with subprime auto? So I would just say to do some self-policing and just more generally, if you could solve for things like backup servicing and other continuity related stuff and show almost like a living will to lenders and, people who are leading securitizations, you'll be pretty well situated because those are things that coming from banking folks focus on. I'm going to pause there.
Great. No, thank you. So we're at exactly a 40-minute mark, which is where we wanted to be. I don't see any questions, which is a little surprising to me. Maybe people are nervous. But I guess that's a good way to finish this webinar. James and Rob, I'm very grateful for your time. Thank you for your input. It was tremendous, and I appreciate to all of those who joined this webinar. Please feel free to reach out to any three of us if you have any questions. Otherwise, we hope to see you soon in a couple of months at our firm's workshop. Thanks,
Yeah,
everyone.
appreciate it, and happy to help whenever, guys. So reach out, even if I'm not making money. I'm happy to give some feedback on how I might be able to help you make more money. And I'm sure James will do the same. So thank you again, Felix, and I'll pass over to James for parting comments from him.
Yeah, thanks, Felix. Thanks for the opportunity. And yeah, if anybody has any questions, we're happy to take any questions at all offline and help out in any way. Even if you're not looking for capital, if you are looking for advice on how to get ready to be able to raise capital and the different pools, pockets of capital that can be available, happy to be a resource there. But Felix, thanks for the opportunity and look forward to seeing you at the regulatory conference. Appreciate
Great.
it.
Thanks,
Thanks,
everyone.
guys.
Take care.
Thanks.
Bye-bye.